does UK inheritance tax apply to my UK pension if I live overseas? There's been significant changes to pension legislation surrounding UK pension schemes because they now fall under your estate for inheritance tax. And to explain how inheritance tax works, firstly, in the UK you have something called a nil rate band, and you have £325,000 which is exempt from inheritance tax per individual. If you're a married couple, that's £650,000, and then you also have something called a residential nil rate band, which is £175,000, which is also exempt from your main residence in the UK. So that means if you're a UK resident and you're married, then you have £1 million which is exempt from UK inheritance tax. Once you leave the UK though, you no longer have your main residence in the UK, which means the maximum you can get per individual is £325,000. And this can be problematic if you've built up a pension scheme over the years because it didn't fall under inheritance tax, because this is now going to fall under UK inheritance. One thing to bear in mind though is if you are planning to stay outside of the UK for a long period of time, there have been changes surrounding UK domicile status, and it's very, very simple now. In the past, the UK domicile status was pretty much based on where your parents were born, and it went off the father first. So if your father was a UK passport holder, then more or less you were going to be UK domicile regardless of how hard you tried to shake that off. Now though, if you're outside of the UK for more than 10 consecutive tax years, you would be classed as a non-UK resident, even if you're a UK passport holder, which means the UK would only tax you based on your UK-based assets. And this comes into effect in April 2027. So what that means is you need to look at what you've got in the UK. The problem with the pension scheme now, a UK pension scheme, is you can't transfer it easily into a QROPS, whereas in the past you could. You can only transfer it into a QROPS if there's a QROPS in the country where you're living and they accept transfers from a UK pension scheme. Because a lot of QROPS that are based in certain countries could be specifically for that company. In the past, the two main jurisdictions where people went into a QROPS was Malta and Gibraltar. So if you are living in Malta and Gibraltar, there is a bit of a loophole still because you can use those jurisdictions. But if you're living in other countries, then there aren't that good options available for a QROPS. Because if the QROPS is in a different country to where you're living, you have what's called an overseas transfer charge, which means there's a 25% tax charge on transfer, which of course you want to avoid at all costs. So let's just assume the QROPS is not available. The UK pension scheme will have to stay in the UK. So you want to look at bank accounts, you want to look at investment accounts in the UK, ISAs, UK property. If that goes above your nil rate band and it's unnecessary to keep it there, you want to move these assets as quick as possible. So let's just say you had £500,000 in an investment account in the UK, you had £200,000 in cash, and you had £300,000 in the pension pot, and you were single with kids. You've only got £325,000 that wouldn't have the 40% inheritance tax in the UK. The rest will. Now, in this example, luckily the UK pension is below £325,000. You can't do anything with that, but what you can do is close down your UK bank account and set up a UK bank account overseas. You can still keep the money in pounds if you want to, because you've got the benefit these days of using multi-currency accounts. This could be a digital bank, or even local banks have started opening up the option of multi-currencies. So just by moving that money from the UK to somewhere else, you avoid 40% tax on that 200 grand, which is an 80 grand tax bill. Now for the property, you could be keeping this property because you plan to maybe go back to the UK. So if your plans are to go back, then of course you may want to keep that property in the UK. But if not, that is a substantial tax bill on death of £200,000 on that £500,000 property. So more often than not, it makes sense to get rid of that property. If you're using it as an investment, then maybe look at having an investment in a different country. Of course, you also want to make sure you look at the inheritance tax rules in the country where you're living, because if there is a double taxation treaty, you need to see whether the UK inheritance tax is higher than the inheritance tax of where you're going. Generally speaking, it is, because UK inheritance tax is pretty punitive. But that's really the general outline of UK inheritance tax. It is quite complex. It's not one size fits all. So if you do want to find more information out about this, then please contact us and we can run through what the options are based on your current circumstances and what can be done to reduce this inheritance tax bill that may apply to you on death.